could it be that your retirement plan could be significantly strengthened and improved through life insurance? That is the subject of this video. But I'd like to share some ideas with you about how life insurance is used in retirement for retirees to actually improve your retirement income, how to improve your tax liabilities. And so I talk about this. I have a chapter in my book that I go into this subject, but I recently had a interview with Ed Slott, CPA, where it's a 40-minute interview. I'll put a link here below if you want to watch the whole thing. But I'm just going to take some clips from that interview where Ed is talking about life insurance. So before I do, just some concepts here. When you think of the three tax buckets, okay, these are regardless of where your income or assets are held, from a tax standpoint, they're going to be in one of these three buckets. The taxable, tax deferred, these are qualified retirement accounts, IRAs, 401ks, etc., right? Then you have tax-free, which is typically going to be Roth 401ks, Roth IRAs, Roth TSPs, Roth conversions. We love Roth because we love tax-free. And tax planning has become such an important part of a good retirement plan, where taxes are set to go up, and most Americans have done most of their savings in tax-deferred retirement accounts. And so there's a significant amount of improvement of a retirement income plan when there's a good, well-thought-out, proactive tax strategy. Now, and for some people, so getting money into Roth can sometimes be very challenging, right? Especially if you have money that's not in a qualified account. And maybe if you're already retired, because you have to have earned income in order to make contributions. Contribution limits are limited. And so if you don't have much money in a qualified account, how else can we get money into a tax-free environment? And there's really only one real way to do that, and that would be through some life insurance strategies. Now, a lot of times people think that it makes no sense to have life insurance, but there's been a lot of innovation in recent years with the policies of how they're structured. So now, with a good strategy for certain people, there's multiple things that can be accomplished with a particular type of life insurance strategy. One is the long-term care issue. Having insurance that's affordable, that should you or your spouse need long-term care, you've actually got a chunk of money, tax-free money, that would be available for that purpose. So it's a very powerful tool for that. Also, just tax-free growth. As you'll hear Ed Slott talk about how important life insurance can be from a tax standpoint, he says it's one of the single biggest tax advantage in the tax code is to be found through life insurance. And it's a sophisticated tool. It takes good planning. If someone that kind of doesn't know what they're doing, it can be done wrong and it can be done right. And it's going to really depend on each situation. So you just want to make sure, if you consider it, you've got people who are skilled and understand all the nuances that go into it. So with that, let me share some of this footage from Ed Slott and what he has to say, and then I'll conclude. I've heard you teach and talk quite a bit about some of the alternatives to qualified plans, right? Such as life insurance, for example. Oh, yeah. Tell me, summarize a little bit your feelings on that.
No, this is where the book comes in, and I have chapters on each of these things. Here's my feeling. The IRA, the 401k thing, the idea was good in the beginning, but maybe not so much. Because all we did, as I said earlier, we are just building a savings account for the government. I would go as far as to say, which I did say in an article last year in Investment News, which was the #1 most read article. Probably, I don't even know if people read the article, but the title brought out a lot of people. The title said, Stop Contributing to IRAs. It was the number one article. And remember, Investment News doesn't just write about retirement. They write about everything. Of all the articles for 2023, the most downloaded, the most, I'd like to say read, but who knows if they read it. They probably just looked at the title. What is this guy talking about? Mr. IRA, stop contributing to IRAs? Well, that's like contributing and growing your mortgage. Let's say you have a mortgage rate, 3-4%. Some people say, well, maybe it's good to have a home mortgage if you can earn 5-6-7%, anything more than the mortgage rate, right? So some people say, yeah, I'd rather borrow the money, put it in the market wherever I invest, and I can earn more. Net, I'm ahead, right? What if I change the example? What if you walked into the bank and or the bank came to you, that's even a better one, and they said, you know that 3% fixed rate? We're changing it. We decided we want 10 times more. We're changing it to 30%. You know what? We were thinking 30, 40. Well, let's make it 35%, okay? We're going to charge you 35%. Would you continue to load up that mortgage? Well, that's exactly what you're doing with an IRA. It's not a 3% rate. It's the tax rate. And every time you add to this mortgage, that's what's on your IRA for, a mortgage. You're adding to the government's take. And unlike the 3% or 4% or 5% mortgage rate you might have, the actual rate to get rid of the IRA mortgage, the government's share of your retirement account, it could be about 35, 20, 35. It's way more than the mortgage rate. Let's put it that way. High-income people could be 40%. Then you have state tax. Who knows? So, because every minute the IRA grows, it's growing against you, not for you, compounding against you. If you bring it down and get the money out, you get something for that money you're paying up front. You get tax freedom. You get the opportunity to do a few things. I'm not just saying take that money out, pay the tax, and let it sit around. No, you're going to move it to tax-free territory. Things like you just asked me about, Roth IRAs. I'm a big fan because I love tax-free. Life insurance. Most people don't think of that. I have a whole chapter in this book just on those two. But the name of the chapter name for the life insurance, actually, the two chapter names are interesting. They don't say Roth IRAs or life insurance. The Roth IRA chapter is called Congress's Single Best Gift. The life insurance chapter is called The Power of Life Insurance. Why? Because you're moving, I love this line, I've been using it for 30 years, moving your money from accounts that are forever taxed to never taxed. Forever tax is tax deferred. It means you're still sharing with the government. You get it out at low rates, move it maybe to Roth IRAs, or use it for life insurance. Now, I'm not a life insurance guy. As I told you, I'm a CPA. I think you know that. I don't sell stocks, bonds, funds, insurance, annuities, none of that stuff. Right. But the reason I have a whole chapter on life insurance, which you asked about, and I'm talking about permanent life insurance with cash value. Right. The reason I have a whole chapter on that is because even though I don't sell it, I'm a tax advisor, but as a tax advisor, I have to tell you that the income tax exemption for life insurance is is the single biggest benefit in the tax code and not used nearly enough. This is from a non-life insurance guy. I'm not telling you what products. I'm not a product guy. All I know is what it does at the end. The cash value grows tax-free. I have it myself. I had it for people in my family. I've done it for everybody. And I'm going to reveal something on your show. I was going to say, which I never revealed before, but I always reveal it. But it'll sound a minute. I'm going to give you the exact balance in my IRA. Zero, because I paid off that mortgage years ago when I begged everybody. Remember 2010, I said, take that deal. Well, everything I'm telling you, and I have in the book, I've done for myself and my family. I have a zero IRA. In 2010, when they changed the law, I converted everything to the Roth on that special deal where you could pay no tax in 2010, half in 11, half in 12. I begged people back in 2010, take that deal. The government's giving everybody an interest-free loan to build a tax-free savings account. But again, people were short-sighted. Oh, I don't want to pay anything. I want to just watch it grow for the government. I don't get it. So the Roth is one option. You move it to a Roth IRA, then the compounding starts to work for you. There are no RMDs during your lifetime. You can keep that money growing, income tax-free, for the rest of your life. And even under the new strict Secure and Secure 2.0 rules, 10 years beyond for your beneficiaries. Imagine all that compounding, accumulating, snowballing, absolutely income tax-free for you and your family. You'll make up whatever little amount of tax you paid up front many times over if you look at the big picture. So that's one option, moving from forever tax to never tax. But the other way, and you could do a combination of both, I did that for myself and my family, is move the money, again, get the money out. But you got to bring that IRA balance. Think of it as that 30% mortgage. Let's bring it down because we could do better things with it. Have it grow in the Roth or have it grow in permanent life insurance, cash value. And some people, when I talk about life insurance at the programs, they give me that look, oh, Ed, please, life insurance. And I know what they're thinking. And I tell them that. I said, I see you like my whole seminar right up until I said the two words life insurance. And then everything drained out of your faces. And I said, I know what you're thinking. You're thinking, Ed, life insurance? Come on. What's in it for me? I just pay everybody and then I drop dead. What's in it for me? And I asked them, is that what you're thinking? They said, yeah. I said, I agree with you. But many people don't realize there's a lot in it. Everybody knows about the payout to beneficiaries. Some people don't even realize that's income tax-free. Can even be estate tax-free if set up properly. But most people say, all right, so what? They have plenty. They're going to get plenty. Why should I pay money to help? All right, I get that, all right? But there are lifetime benefits. I don't think many people know that. So I always throw out the question, makes people's heads turn around like an exorcist. I like that reaction. I say, all right, let me ask you this. Can you be the beneficiary of your own life insurance without dying? Can you be the beneficiary of your own life insurance without dying? And I see their heads go, wait, what? It's like I scratched the record in their head. They would think, I don't want to hear about life insurance. What is he talking about? Lifetime benefits. I have it myself for my family. The building of the cash value. If you need it during life, and I'm oversimplifying, somebody like Lane here probably, or your insurance or financial professionals that sell these things. If I need it during lifetime, you can access it, in essence, taking an advance on your life insurance, absolutely tax-free. Now, hopefully you don't need it. If you don't need it, yes, it compounds. It compounds tax-free, and your beneficiaries get this windfall tax-free. But if you need it, you can access it. Isn't it better growing in a tax-free account than growing in a taxable account? Just because you didn't want to pay tax to whittle this down, and you're going to have to pay the tax anyway. I always say you want your plan, not the government plan. When I say that, Lane, in seminars, people sometimes say, I can't believe it, but it still happens. They say, Ed, you keep saying you want your plan, not the government plan, but you never said what the government plan is. What is the government plan? Maybe I'm interested. No, you're not interested in that plan. But if you have to know what it is, it's very easy. Do absolutely nothing. Do nothing.
Yeah.
Because at 73, the government plan kicks in and you'll be forced to take distributions at whatever the prevailing rate is. I'm worried it's going to be more. And remember, when you do the kind of planning I'm talking about here, getting the money out at low rates, you can actually control your tax rates. That's another key to good tax planning. You can say how much I'm taking out of the IRA and moving to the Roth, how much I'm taking out of the IRA at the 12%, the 22% bracket, which expand every year and putting it into life insurance. The brackets, I said before, are key because if you don't maximize every dollar of these low brackets, you never get them again. A bracket wasted, you don't get credit the following year because you've left, $50,000 of the 12% bracket on the table. You want to get every ounce out of those low brackets so you can have access to your life insurance cash value. And as you do it, you're going to watch it grow. I have the same thing myself. And I did about 10 years ago, Lane, I did one of these 10-pay things because I found out You probably knew about this before that, but about 10 years ago, I first learned that you could get long-term care benefits, a long-term care rider on your permanent life insurance. So I scrapped my old one. I transferred it over. We did all that stuff. And I actually got more insurance, and I did a 10-pay thing. So I'm in the 9th year. I have one more payment. But I watched the cash value go up, and I look, how is this even possible? The clients ask that too when I talk about life insurance, because I show them with a math that they could actually end up with more than they ever had. And then they say, but how is it possible? Won't the insurance companies go broke? No, they have this figured out. They're the biggest bookies on earth. They know the odds. I mean, forget the Las Vegas guys. These guys are the professionals. They know everything. They have actuaries. Don't worry about them. People ask me, how is it possible? You're worried about them? You ever say? So I look at the cash value. It's more than I even paid in. And I had the coverage for all these years in case I did die. And now if I need, I hope I don't need it, if I need the access, turned out to be a pretty good savings account, all growing tax-free. Tax-free money always grows the fastest because it's not eroded by current or future taxes. Again, you're not sharing with anybody. You don't have to be a good sharer. I'm not a good sharer. When I go to restaurants, I like to get a shrimp cocktail, right? And this is true from when my kids were young growing up. I always liked these shrimp cocktails. And they would always want one shrimp. And I said, forget it. I don't share. Why? Basically, they only give you like 3 shrimps. And I figure, as an accountant, if I give one away, that's a 33% loss right up front. I tell them, get your own. You know what I mean? I'm not a good sharer. Share is good for your toys and your crayons and your snacks like they teach you at school, but not your money. There's no obligation. But the problem is most people do the government plan. They're not in control of their tax rates because either they don't have access to this information or they don't have access to an advisor like you, and they have the actual run-of-the-mill advisor says, look how much money I made you. Until the market goes down, then they say, look how much money I lost you. So big. But they don't play the second half of the game. I often use sports analogies for these things. And if you notice in football, you notice how college games and professional games, in almost every game, it seems like the last few years, the game is won or lost in the last 5 to 10 seconds. You ever notice that? It's the same thing with taxes. It's what you do at the end of the game. You've already worked your first half. You did all the working, the building, the saving, the investing, the sacrificing. But then you give up. You say, oh, I've done everything I can for retirement. It's only halftime. You don't walk off the field in halftime and say, I'm all done. I've done everything. Because if you do, you're in the locker room. IRS is coming out. They're playing the 3rd or 4th quarter. They're playing nobody, so they win. Because you don't have your plan. You end up with the government plan. This money will be taxed. The whole key here is to get the money out at the lowest rates possible and then leverage that into tax-free vehicles where the compounding works for you and your family, your beneficiaries. And the best ways to do that are Roth IRAs, life insurance. What do they have in common? They build income tax-free. But there's another way to do it too. And I cover all of this in the book. And I know you've been studying all of this, charitable planning. For those of you who like to give to charity, IRAs are the best assets to give to charity because they're loaded with taxes. But charities don't pay taxes. So give them all your dregs. Give them all these IRAs. They're the worst assets because of the way Congress made the law in Secure and Secure 2.0. They downgraded IRAs. They're a horrible wealth transfer or estate planning asset to give to beneficiaries. They're loaded with taxes. The rules are complicated. The beneficiaries are going to get hit with all of this. The best thing a beneficiary can inherit is a tax-free account like a Roth IRA. It's still an IRA, but at least income tax-free. Or these mountains of tax-free life insurance. I never heard of anybody complain that there was too much life insurance after a person died. The complaints I do hear, and I have my own complaints too, as I look back at the planning I just told you I did for my family, I always say I should have got more life insurance. I don't know anybody who has life insurance, and I have millions of this stuff. But do you ever notice that? Everybody that has it wish they had more, right?
Right. Yeah. So think of life insurance as a sophisticated financial tool, because that's what it is. And with any financial tool, it needs to be handled with care. And what may be a good fit for one person may be terrible for another because their situation is different. And so there is no one size fits all with anything. Now, in the case of life insurance, not everyone can get it, for those that want it, because you have to go through underwriting. So you have to be in generally good health to get it in the first place, because there is the life insurance component. There is a savings component where you get the tax-free growth and for future income. There's the portion that gets paid out if there's a need for long-term care. Anyway, it's multifaceted, but it is a powerful tool for many people, especially if you're trying to get money into the tax-free bucket and you're having a hard time because there are contribution limits on Roth IRAs, Roth 401ks, and you may not have the time to get enough money put in, where with a custom life insurance strategy that's well designed, there are no contribution limits. You can put in really large amounts. And so it's a really powerful tool used by just millions of people. The more high net worth you are, the more likely you're going to want or need a life insurance strategy. So just know that it's out there. There's very strong tax advantages, and it may be something that will really finish off your retirement plan as far as providing not only the long-term care protection, not only the tax-free growth, but also a tax-free legacy that could protect a spouse, it could protect children, help cover estate taxes. There's a lot of benefits when it's put together in a comprehensive plan. So I hope you found this beneficial and educational, and I look forward to seeing you in the next episode of the Financial Fast Lane.